Let's go more into the role of the CEO. The CEO is the middle person between the owner and the creditor and has to balance out their different interests. The creditor provides loans to the company and the owner provides equity to the company. And by providing equity, the owner is entitled to all the profits of the company going forward into the future, but the company has to pay all the interest to all the loans for every creditor down to the last dollar before the owners can actually earn any profits. And the terms of their investments are very different. If you think about a creditor or a lender, their loans are defined up front. All the terms and conditions are agreed at the point that the contract is signed. On top of that, the income going to the creditor is typically fixed, whether it's fixed at a particular number like 5% or 6%, or it's a floating rate, but it's fixed at a particular interest rate. And it's not up to the CEO or to anyone else in the company what that interest rate is. It's determined in the fixed income markets. Finally, the loan has a limited duration. It could be a 1-year, 10-year, 50-year duration, but ultimately the loan comes to an end. The owner or the equity investor has a much different type of relationship with the company. First of all, their profits are not guaranteed. The interest rates are guaranteed to a creditor. Profits are not guaranteed to the owners. So they can in fact suffer losses. It is not a legal requirement for the company to actually earn profits. The CEOs are only required to try their best to earn profits. And it's very possible that they could fail and the owners take the burden of that risk. And the investment of the owners into the company can technically be forever. It can even go past the lifetime of the owners. There's no limit to the time limit to the investment that a owner makes by buying equity in a company compared to a loan that a creditor makes to the company. So to summarize, the CEO has to decide which is the best stakeholder from which to source money to buy assets. The CEO can choose to borrow money from creditors and pay them interest, or the CEO can choose to take investments from new owners by selling them shares of stock in the company and then pay them future profits. So whichever deal is best for the company is the one that the CEO is going to try to make. But you can already see that because creditors are much more risk averse, they don't want to see the company take huge bets that could threaten their future interest payments. Owners, however, tend to be a little more open to taking risk, and they'll encourage and sometimes insist that the CEO takes big moonshot risks in order to increase the chance of a very big payout for them in terms of future profits. Now, you might be wondering, why would anyone want to be a creditor when their income is so limited and fixed to an interest rate? And the answer is that if a company goes too reckless and tries to please its owners too much and makes bad decisions and produces future losses instead of future profits, the creditors have priority in the bankruptcy. All the assets of the company, or the ones remaining, belong to the creditors until their loans have been repaid in full. And only after that point do the owners have the ability to realize any gains from the sales of the residual assets after the creditors have been made whole. So in a bankruptcy scenario, creditors typically have power over the owners. Now, what makes the job of the CEO even more difficult is that there's a bunch of other stakeholders that are necessary for the success of the company. There are employees, there are customers, there are suppliers, the board of directors, the auditors, and the government. Each one of these stakeholders probably deals with multiple companies or multiple different priorities in their lives. Employees might be raising families, customers have other places to shop, suppliers have other customers. A director on the board of directors can also work for other companies or be a CEO himself or herself. Auditors have to look at multiple companies and make sure they're all being audited professionally and accurately. And the government obviously has thousands of companies to look after. So the CEO has a limited amount of time to focus the energy and the thinking of all these stakeholders. And that's why the emoji here is of a stressed out CEO. Now, specifically, the CEO is accountable to the shareholders, the people who provide the equity. And the CEO must increase the value of the company by consistently increasing profits for shareholders over time. This is the job description of every CEO. No matter what else shareholders expect the CEO to do, they all expect the CEO to do this service for them. Now, in order to be successful, the CEO must maximize current profits and use those profits to invest wisely for the future. It is today's profits that fund tomorrow's products. And to make good decisions about future projects and future products, the CEO has to ask, well, which ones are worth the risk? And they have to map the money that they get from the owners and the money that they get from the creditors to these potential projects and try and assess which ones will satisfy both stakeholders. And then next is, what is the right price to pay for an asset? If you own a car company and you have thousands of different types of factory tools and machines that you can buy or upgrade, not only do you have to choose the right one, but you also have to decide what the correct price is to pay for it, because every time you buy something, the number of options you have to buy other assets decreases. On top of that, the CEO also has to be aware of how their competitors are funding and investing in their projects, because they have to be able to outsmart and outperform the investments of their competitors. And then the CEO always has to be constantly aware, well, do I have the support and buy-in of everyone? If even one of the stakeholders decides to withhold their support, if the employees object to the strategy or to their compensation, if the auditors think that the financial record keeping is not up to par, the withdrawal of support from even one of the stakeholders could be fatal to the success of the company. So to increase profits consistently over time, not just 1 year or 2 years, the CEO has to balance the interests and meet the expectations of all company stakeholders and make sure that by doing that, they enrich their owners. Now, the reason why CEOs have a tough time is because sometimes it's not obvious where the competition is going to come from, and it's not obvious which assets are the right ones to buy. So, for example, here's the AI industry. There's a certain amount of profits in the future. There's OpenAI, there's Facebook, Amazon, Microsoft, and then there's all these startups that are coming out. And if you're Microsoft, not only do you have to worry about the big companies out there like Facebook and Amazon, but you have to worry about those garage startups and those spin-offs coming from MIT and other schools, because they might be the ones who are making the correct decisions that you've overlooked. If we think about the competitive landscape and how much has changed in the past couple of years, think about this. Uber and Lyft have taken out limos and taxis, and now Waymo and Zoox is coming after Uber and Lyft with their autonomous cars. Google and Facebook really, I could say, destroyed the ad industry for TVs and newspapers and took all the profits for themselves, but now ChatGPT is coming for their profits. Netflix did the same thing to not just one, but two industries, the cable industry and the movie studios at the same time. Apple did the same with the smartphones against BlackBerry, Ericsson, and Nokia. It seems strange to think now, but two or three decades ago, those companies were the dominant ones in the growing smartphone industry. And SpaceX, they were a startup basically out of a garage, a very big garage, and they took on Boeing and Lockheed in the space launch industry. NVIDIA also took down Intel. So you get the idea of how difficult the competition is. In fact, you can compare the industrial competition to the competition in the natural ecosystem. You have different species preying on each other. It's a very nerve-wracking type of experience. It's very Darwinian. The best and most adaptable will survive, and the way companies survive is by claiming and earning profits today and profits tomorrow for their shareholders. So competition is good for consumers, but it's bad for companies. The CEO is constantly asking, who are my current competitors and how do I beat them? Who are my future competitors and how do I prepare for them? Unless the CEO runs a monopoly. And it's hard to identify monopolies in the US unless, well, they tend to be government-run businesses like the Department of Motor Vehicles. They're a monopoly. You can only get your driver's license from them. The post office, you can only deliver letters to them. But generally speaking, relative to other countries, there are not that many monopolies in America, and so CEOs always have to be on the lookout. As discussed, profits attract competitors, and to continue making profits, the investments that CEOs make into projects and assets have to do one of two things. They either have to increase sales or they have to lower costs. These investments cost money, and the three sources of capital that we referred to earlier were equity from owners, debt from creditors, and retained earnings, which also belong to the owners. If you think about the balance sheet of the company, the assets of the company are paid for either by the owners or by the creditors. And as long as the company pays the interest and fulfills all its obligations to the creditors, it gets to use those assets to generate earnings for the owners. And the owners' money also is used to invest in assets, and they get to keep all the gains in the value of the assets as well as any income generated by the assets after the creditors have been taken care of. Additionally, the money from the owners has to be available and liquid enough so that if the company ever runs into trouble, the company has enough cash on hand to pay things like payroll and interest costs. Now, with all this having been said, we can take a closer look at the CEO. And interestingly, like us, like you and me, the CEO is also an investor. The CEO has to decide the optimal mix of equity and debt, maximize profits from the current business, invest profits wisely, and outcompete competitors. This requires the CEO to hire good employees, comply with laws and regulations, keep customers happy, keep investors happy. It's hard being CEO, but a lot are still way overpaid, admittedly. Let's hear how a CEO defines his role. This is Satya Nadella of Microsoft.
Shorthand for high-performing tech stocks with market caps bigger than some countries.
The hardest lesson you've learned as CEO?
I think the hardest one is to be able to really live that, right? Deliver the present and then prepare for the future. That ability, like as a CEO, what is it that you have to do? Each quarter, you have to create magic. Right? That's kind of what every 90 days, the market expects you to create magic, and that's kind of the reality of the world we live in, while at the same time building a long-term institution. And the accountability that goes with it, being able to sort of understand what it takes to have that ultimate accountability to both deliver today and for tomorrow, and to be able to get that balance right. So I'm not...
Perfectly stated. Now we can see that the role of a CEO, the decision-making responsibility, is also similar to what if you own a home, it's similar to what a homeowner has to go through. So let's think about what you might do as you decide whether to buy and operate a rental property. Well, you have to decide what your down payment's going to be, which is your equity. You're going to have to decide how much your mortgage loan is going to be, and the bank is your creditor in that case. And then what sort of price can your equity and debt allow you to pay for a rental property, and what are the attributes of that property? Where do you want it to be? What kind of home do you want it to be? Is it a ranch? Is it, what style of property? Do you want to have a fixer-upper that you need to renovate? How much do you want to renovate going forward? Do you want to split it up into one family or two families? All these different types of decisions. These are, in fact, the types of decisions that a CEO has to make. And then you'll notice that when you earn a rental income as a landlord or a landlady, you have to pay the mortgage lender first before you yourself can recognize any income from the property itself. Whether or not you have a tenant or not, you have to pay the bank. And it's similar to a company. Whether a company earns profits or not, they have to pay their creditors. So if you cannot pay your creditors, you'll go into what's called insolvency. You might have to go through a bankruptcy, and the lender will foreclose on your asset and take it away from you because you haven't been able to pay your legal obligation, which is required under the terms of the mortgage, that you have to pay them before you pay yourself. So you have to be very careful about not being too optimistic about how much money you can actually get from your rental property. You have to factor in the possibility that you won't get the rental rate that you would really like. You might have to invest more to fix things or renovate things than you anticipated. And on top of that, you have to also consider that, well, what if you just decided to buy a bond? What if you just decided to invest in a CD? What kind of return could you get for that? So you're doing this comparison shopping that CEOs do too. What is the best asset that I can buy with a mix of my savings and loans that are available to me? So let's apply some of these ideas, some of these fun and interesting ideas to Steve Jobs and Apple and see how they did and what the factors behind their success has been. Thank you.